Two households can earn the same income, live in nearly identical homes, and occupy completely different financial realities. One bought years ago. They locked in a lower price, a lower mortgage rate, and years of equity growth. The other is trying to buy today. They face a higher price, a mortgage rate above 6%, a larger payment, rising insurance costs, and a down payment target that keeps moving. Same neighborhood, same salary, different wealth trajectory. That is why housing affordability is becoming the new wealth divider. It is not just deciding who owns a home. It is deciding who has room left to save, invest, change careers, raise a family, and survive an emergency after paying for housing. As of late May 2026, the average 30-year fixed mortgage rate was 6.53%. The median price of a new home sold in April was $422,500, and the Federal Reserve's latest household report found that only 33% of adults earning under $50,000 own their home, compared with 86% of adults earning $100,000 or more. Housing is no longer just a monthly expense. For many households, it is the financial gate that determines what comes next. This is educational content. It is not financial, legal, tax, real estate, or investment advice. Housing conversations often sound too simple. Owners build wealth, renters do not. But the deeper divide is when someone entered and what the entry cost them. The Federal Reserve reported that the median monthly mortgage payment among homeowners with a mortgage was $1,600 in 2025. For people who moved in 2024 or 2025, the median payment was $2,300. That is a $700 monthly difference, $8,400 per year. Before comparing property taxes, insurance, repairs, or the size and location of the home, the earlier buyer may also have years of equity and a lower mortgage rate. The newer buyer may begin with less cash, a larger payment, and more pressure. This creates a strange economy. People living behind similar front doors can have completely different abilities to build wealth. One household's home supports the rest of the financial plan. The other household's home consumes it. A lender can approve a mortgage. That does not mean the home is affordable. Approval answers a narrow question. Can this borrower probably make the required payment under the lender's rules? Affordability asks a much harder question. What remains after the payment? Can the household still build an emergency fund? Continue retirement contributions? Handle a roof repair? Pay childcare? Absorb an insurance increase? Take a lower-paying opportunity that improves the career later? Or does every financial decision now depend on keeping the next paycheck perfectly intact? The mortgage is only the beginning. Property taxes can rise. Insurance can rise. Repairs arrive without asking permission. More than 6 in 10 insured homeowners told the Federal Reserve that their insurance costs had increased more than expected in recent years. Buying a home without financial margin does not automatically create security. Sometimes it creates a very expensive form of fragility. The down payment is usually treated as one number. Save it, spend it, get the keys. But that cash had other possible jobs. It could have remained an emergency reserve. It could have reduced high-interest debt. It could have supported retirement contributions. It could have funded a business, education, or a move for a better career. That does not make the down payment a mistake. It means the down payment has an opportunity cost. And after closing, ownership keeps demanding cash. Furniture, moving, maintenance, tools, repairs, taxes, insurance. If buying empties every account, the household may own a valuable asset but have no financial shock absorber. That is not wealth yet. That is concentrated risk. Housing affordability divides wealth because it changes the rest of the budget. Imagine two households each earning the same amount. Household 1 has a manageable housing cost. Each month, it can invest, build cash reserves, pay down debt, and make choices from a position of strength. Household 2 stretches to afford housing. Each month, most of its margin disappears before any other goal begins. Over 1 year, the difference may look manageable. Over 10 years, it can become enormous. Not because one household is smarter, not because one works harder, because one had more financial room after housing. That room creates options. Options create resilience, and resilience creates more opportunities to build wealth. This is also why location matters. Affordable housing far from good jobs can create transportation costs and limit career growth. Expensive housing near opportunity can consume the income that opportunity provides. The real goal is not the cheapest home. It is the housing decision that supports the entire financial life. Renting is often described as throwing money away. That is lazy financial advice. Rent pays for shelter, flexibility, and the transfer of many repair risks to the owner. Buying can create equity and long-term stability. It can also create transaction costs, maintenance risk, market risk, and reduced mobility. Neither choice is automatically superior. The question is what each choice allows you to do next. If renting below your means lets you invest consistently, maintain flexibility, and build a strong financial base, renting may support wealth. If buying creates a sustainable payment, preserves reserves, and fits a long-time horizon, ownership may support wealth. But buying an unaffordable home just to stop renting can delay wealth instead of creating it. And renting an expensive lifestyle property while saving nothing can do the same. The label does not decide the outcome. The margin does. Before making a housing decision, stop asking only, how much house can I qualify for? Ask, what remains after housing? Calculate the full monthly cost, mortgage or rent, taxes, insurance, maintenance, utilities, association fees where applicable, transportation changes. Then test the rest of the plan. Can you still save? Can you still invest? Can you survive a major repair or income disruption? How much cash remains after closing or moving? How long do you expect to stay? What career flexibility are you giving up? What opportunity does the down payment replace? The best housing payment is not the largest one a lender approves. It is the one that leaves enough room to build the rest of your life. Housing affordability is the new wealth divider because housing now determines far more than where people live. It determines who has financial margin, who can absorb risk, who can move for opportunity, who can invest consistently, and who spends years trying to reach the starting line. Owning a home can be powerful. Renting can be strategic. Neither one guarantees wealth. The real danger is allowing housing to consume every dollar, every option, and every future decision. Do not measure housing only by the keys you receive. Measure it by the life you can still afford after the door closes. Subscribe for more practical money strategy, financial literacy, and real-world wealth-building breakdowns. And I will see you in the next one.